For every parent, their child means the world to them. They would be happy to sacrifice their own comfort just so their child can be comfortable. Considering this, it is hardly surprising that every parent wishes to provide their offspring with the best of everything in life, even when they may not be around. When it comes to planning for your child's future, an early start can make all the difference. Starting the saving process earlier gives you a longer time period to fulfill the financial goals you're aiming to meet, such as your child's education, marriage, or supporting them in the initial stages of their career. So in this video, we'll show you some best investment options to ensure your child has a secure future. Number 1. Start investing early. Planning investment early for your child can provide you with enough time to save money at your own pace and diversify your investment portfolio with more asset allocation towards equity for better returns. Anna Bensel, Chief Business Officer, Squarebox, said, "Delaying investments is the most common mistake parents make. This typically happens due to time bias, as parents think they have good enough time to achieve their financial goals. However, time is a crucial and irreplaceable part of the investment journey. The sooner you start investing, the easier it will be for you to reach your goals and save for your child." Number 2. Identify short and long-term goals. Not every financial goal has the same maturity. You need to invest differently to save a schooling fund and a fund for higher studies. Thus, it is crucial to identify short and long-term goals and implement goal-based investing to secure your child's financial future. Goal-based investing means capitalizing based on that specific requirement, time horizon, and risk-to-reward ratio. For instance, for a shorter investment duration, you should weigh on liquid and stable investment options such as fixed income instruments. On the other hand, for long-term investment goals, you have the option to invest in mutual fund SIPs, stocks, ETFs, etc. Even for mutual funds, you can invest in large cap, multi-cap, mid-cap, etc. depending on your goals and risk appetite. Number 3. Efficient asset allocation. Efficient asset allocation shows you to invest based on your goals, preferences, and risk appetite. Asset allocation based on your goals ensures that you have the required investment returns at maturity. Based on your goals, you can choose from various options such as mutual funds, fixed income instruments, and more. You must diversify your portfolio asset allocation based not just on investment avenues but also on maturity years. For instance, if your child is 1 year old and you wish to save for his schooling, you do not have the luxury of time. Also, schooling is more than a decade-long process. Thus, you need to save to receive funds regularly during the investment tenure. Your asset allocation should offer you liquidity and the option of partial withdrawals to help you keep up with your child's increasing needs. Number 4. Insurance is a must. Don't forget to add kids to your family floater health insurance policy. Having adequate health insurance for your child is equally important as saving adequately for his future. While children are less prone to severe diseases, they're more likely to injure themselves while playing or get infectious diseases. Such occurrences on a repeat can prove daunting to you emotionally as well as financially. Number 5. Educate financial literacy at a young age. As a parent, if you wish your child to grow as a financially independent adult, you must make them aware of financial literacy. This responsibility to teach your child financial literacy will help them learn how to value money and use it wisely. If fundamentals like savings, investments, debt management, etc. are taught at a young age, they form a solid base for your child's financial habits. You should help your child understand how you earn and save money for them, and how it will help them in the future. You must encourage your child to differentiate between needs versus wants and let them budget their pocket money to understand the value of money. Also, pass your wisdom and experiences on your investment successes and failures to lead by example for your child. Number 6. Start planning and investing in their higher education. It is never too soon to start planning for your child's higher education. Starting early gives you ample time to grow your wealth and helps you achieve your financial goals by investing small amounts of money consistently. Higher education is a costly affair and one that should never be bound by monetary compromises. You can consider factors like the current cost of education, inflation rate, child's age, admission age, expected returns, etc. This will help you arrive at a goal amount, and since this is a long-term goal, you can allocate the majority of your money to equity-based investment options to earn inflation-beating returns. Number 7. Set up a bank account in your child's name. One of the first conversations that new parents have about their child is the name. Christening titles to hopes and dreams. While we secure the aspirations we have for our young children with names, one of the first steps to incorporating the safety of their financial future is opening a bank account under their name. Setting aside an account will help accumulate money only for your child and can also be used to accumulate any gifts and presents from relatives and friends. Number 8. Junior Self-Invested Personal Pension (SIPP). Your child's retirement may seem a world away, but if you're someone who likes planning for the long term, you can consider opening a junior SIPP. Similar to adult pension schemes, junior SIPPs are eligible for 20% tax relief. Save £2,800 a year, and £3,600 goes into the SIPP, which is the limit that can be paid into a junior SIPP unless your child has earnings of more than this. However, it's worth noting that tax benefits and rules depend on individual circumstances, and they are likely to change between now and when your child reaches retirement. Also, like other pension schemes, the money you save can't be accessed until your child is 55. You should also bear in mind that the value of investments can fall as well as rise, so your child could get back less than you invest. Number 9. Fixed deposit. It is widely known that compared to a traditional savings bank account, a fixed deposit offers a relatively higher rate of profit on capital. Opening a fixed deposit account is easy, and almost every leading public and private bank offers this facility. Currently, fixed deposit rates range from 5.75% to 6.75%. Number 10 is endowment policies. Endowment plans are more or less like life insurance plans, the only difference being that they also allow you to make savings over a specified time period. If the life-assured individual survives the policy term, they will receive an assured lump sum maturity amount which will be utilized and can be utilized towards fulfilling upcoming financial requirements like paying children's tuition fees, investing in child plans, etc. If the assured policyholder dies before the policy matures, the sum assured maturity amount will be provided to their beneficiary. Number 11. Junior ISAs. Launched in 2011 to replace the Child Trust Fund, Junior ISAs are tax-free savings accounts for under 18s. There are two types of Junior ISA: cash, where they don't pay tax on profit earned, and stocks and shares, where the money is invested and they don't pay tax on capital growth. They can save into one or both types of Junior ISA, and the current limit is £4,080 for the 2016-17 tax year. With a Junior ISA, your child can take control of their account at 16, though they can't withdraw money until they're 18. Between these years, they can hold both a Junior ISA and Adult ISA, which will boost their tax-free savings for 2 years. If you're confident your child will manage their money well, a Junior ISA could be a good option. But if you're worried that they'll go on a savings splurge that moment they reach adulthood, your money will be better invested elsewhere. Number 12. Mutual funds, SIP. Mutual funds or SIPs, systematic investment plans, are a popular investment option, especially for those who are not very savvy with investing or are short on time or money. Being relatively simple to understand, mutual funds exchanges are done on a large scale, which allows investors to reap benefits that are greater compared to the investment costs. A SIP can be stated with a minimum investment of as low as 500 rupees. When it comes to investing, there are certain things which one must keep in mind in order to reach their financial goal. Details such as planned maturity dates, premium due dates, or investment amounts must be monitored. When planning to invest, it is advisable to consult an expert who can advise and guide you regarding the plans which are most suitable for your child's needs. Planning is at the very heart of investment process, which can help you overcome any hurdles which you may face on the way to fulfilling your investment goals and thereby securing your child's future and happiness. Please like the video and subscribe to our channel for more finance-related videos. Thank you and have a good day.